my name is Nanette Abuhoff Jacobson. I'm a multi-asset strategist in Wellington Management, and I'm delighted to be joined by Danny Cook, also a strategist and co-author of our quarterly Multi-Asset Outlook. This quarter, our outlook is entitled, With Growth and Policy, Which Matters More, Level or Change? And the way we reconcile this dynamic is we think there are going to be two competing narratives. One is the overall level of strength and policy stimulus, which we think is pretty strong. But the other is the change. And the change is what's deteriorating and definitely slowing down, both from a policy standpoint with the Fed beginning to taper and also from a growth standpoint. So let me dive right into the key points. 4 points to be made. As I said, we do think that the level of growth and policy is strong, but the change is negative for both aspects of the outlook. That leaves us pro-risk, but really marginally so. And we've actually taken some beta risk down in our portfolios. Now, within equities, we prefer Europe. You'll see that Europe has actually the highest vaccination rate now, and we think that is a key part of the fundamental story. And so we think that Europe will outperform other economies. And Europe also has room for fiscal stimulus, which could be an added bonus for growth. Third point is inflation pressures. We've been talking about this for a long time, and we think that inflation pressures will remain more persistent than the market and the Fed thinks. And for that reason, we're still recommending an overweight to commodities. And the fourth point is about interest rates. We've already seen somewhat of a rise in interest rates, and we still think government bond yields are vulnerable to rising somewhat because of the persistence in inflation that we see. Of course, upside and downside risks. The upside risk is that maybe we will see a productivity miracle and then growth will continue without inciting inflation. And on the downside, of course, if we get a COVID variant that escapes vaccination efficacy, that'll be a big problem. But aside from that, let's stick with the base case, and I will go through our multi-asset views. So as I said, at a high level over the next 12 months, we are expecting equities to outperform bonds. If we drill down into the specific asset classes within equities, as I said, we are expressing our overweight in European equities. In emerging markets equities, we've actually taken our weight down for a modest overweight to neutral. And the reason is that China, which represents 35% of the emerging markets index, is slowing. And that has been highlighted what's happened at property developers, and particularly Evergrande, which has been in the news lately. So if China is slowing, it's inevitable that emerging markets will be challenged. Commodities, as I said, that is our best expression of our view that inflation will rise and be somewhat more persistent than the market thinks. And then moving over to fixed income on 10-year rates, we are moderately bearish, expressing that in US rates and European rates. And then in credit, spreads are tight, but we're neutral there because default rates are really low. And within credit, we prefer floating rate like bank loans. And there are some niches of the securitized asset market that are also floating rate, and also emerging markets debt. Now here, this might seem a little bit contradictory to our equity view, but spreads in EM debt are very wide, and we have more confidence that those will mean revert. So I'm going to talk a little bit more about the fundamental view. And as I said, a key part of our outlook is the path of COVID. And what this slide is showing is the vaccination rates across regions. And the bottom line you'll see is the cumulative rate of unvaccinated people. There are 5.5 billion people who are still unvaccinated, unfortunately, mostly in the emerging markets world. And while access has been difficult, what it does mean is it does set the ground for possibly other variants to arise. And even, as I said, in the worst case scenario, for them to escape the protection of the current vaccines. Now, that's not our base case. However, we do feel that we're not completely out of the woods on COVID. And that is why we saw the dip in growth because of the Delta variant, and we could face something similar in the future. So that's on growth. Let's turn to inflation. And of course, inflation has begun to rise more than the markets expected. And we continue to think that inflation could be more persistent than what the markets or the Fed thinks. The three key ingredients to inflation have been labor, commodities, and freight. And all three operate in an interconnected way. These are not independent forces. We've got labor shortages. We clearly have shortages of raw materials. And finally, to ship stuff is taking twice or three times as long as it usually does. So because of these three interactions, we do think inflation risk is more systemic than the market appreciates. So that's something that we're keeping an eye out for as well. I'm going to pause there, and I'd like to turn it over to Danny to talk about how this is being priced into the markets, starting with inflation reflected in rates.
Thanks, Nanette. So rising inflation has been a major theme in markets, and it's definitely something the Fed is closely watching. The chart shows what the Fed and what the market are expecting the Fed funds rate to be at the end of this year, next year, and 2023. So since we created this in late September, the market started to price in a bit more tightening, and that's a trend that we think is going to continue and should support our slight duration underweight. Turning to equity regions, we think Europe could be the regional winner. The first reason for that is the strength of the vaccination campaigns. So basically, the strategy has been to make it really hard to do a lot of things if you're unvaccinated. And so unlike last spring, the US is now a laggard when it comes to vaccinations. The other two reasons to be long European equities are valuations versus the US and the potential for more fiscal. So on fiscal, the chart makes the point that the EU's budget balance is in a better starting point relative to the US. And so the EU has relatively more room to spend. Now, the country with the most room, Germany, recently had a general election, which should help pave the way for a bit more fiscal stimulus going forward. Okay, so let's spend a minute on China, which is far and away the biggest piece of the EM equity index. From a high level, we've been expecting China to slow as a result of its deleveraging campaign, which I think is brought to life by this chart, which shows the credit impulse in dark blue. So clearly, credit is still key in China, and when that turns down, it tends to augur poorly for Chinese equities. We're also closely watching the regulatory backdrop and kind of the extent to which China prioritizes social equality over market opening. So all that said, there are still lots of great companies in China. It's an enormous and fast-growing market, and our bottoms-up folks are still finding great opportunities. But from our top-down perspective, we're on the sidelines for now until we get a little more clarity on the macro cycle and the policy backdrop. Turning to equity valuations, the top panel here shows valuations versus each of those regions' own histories. And the takeaway is that the market generally has gotten more expensive, clearly led by the US. The bottom panel shows the relative premium you have to pay to invest in US equities. And that premium is just about as high as it's ever been relative to any of the other major regions. And so despite the fact that the US economy may do fairly well, there are certainly cheaper alternatives outside of the US. And so those are equity valuations. Nanette, what are you seeing when you look at credit valuations?
Thanks, Danny. And credit is really in a tough spot in the sense that spreads are really tight. And what we see on this slide is where current spreads are and how that relates to history. The only standout in terms of value is emerging markets debt. Spreads are almost at the median percentile, which is quite unusual relative to other sectors. And as I said, not only is it cheap relative to its own history, it's cheap relative to other sectors. And in particular, if we look at the next slide, EM debt looks cheap to high yield. Now, I will say just about the other sectors that are on the rich side, why are we just neutral and not underweight credit? And the reason is that the default rate in speculative credit and just overall default rates are very low. They're in fact half of the long-term average at 2% versus 4%. So where we see the value, as I said, is emerging markets debt. It also it looks cheap versus high yield, and certainly investment grade credit as well when you compare investment grade EM. So neutral overall with some niches of value. Also in securitized assets, there's floating rate debt. Bank loans are floating rate also. And of course, those will benefit once the Fed pulls the trigger and starts hiking rates. Finally, in securitized assets, we do continue to see value in some niches of the market that are related to residential housing. So I'll stop there. That's it in a nutshell, but I'll turn it back to you, Danny, to just sum up what we've talked about.
And so as someone remarked when we presented this internally last week, it's a compelling case to not have a lot of high conviction positions in portfolios. But our job is to call it like we see it. And right now, we think our base cases on the macro cycle and policy just aren't terribly different from what's priced in. And so our position sizes are a little more modest than normal. In some, we think the level of growth and the level of policy are quite strong, but have to acknowledge that the second derivative of both are likely negative. And so we're pro risk, but not taking big positions. We want to thank everyone for joining us, wish you luck this quarter, and remind you to keep an eye out for our 2022 annual outlook, which we're starting to think about already, and we'll be excited to share with you soon. Thank you.